Hey guys, welcome back to the channel. Today's video, we're going to be looking at some big changes that are coming to the mortgage industry as of May 1st. These changes are going to be in effect. Now, if you currently have a mortgage that is in process, refinance, things of that nature, that is not going to be effective. But again, May 1st, if you do a new application for a mortgage, it is going to change. Now, if you're like me and you've really focused a lot on building credit, even helping a lot of other people building credit, in a single moment, the fees for a vast majority of new mortgages in the United States have changed. In some cases, the changes are drastic, for better or worse. So let's break this down. Now, this is an article from Mortgage News Daily. I really want to go through this with a fine-tooth comb, tell you exactly what it means to break it down. Now, what do you mean by fees and costs? Those are really two different things, guys. This refers to the loan level pricing adjustment imposed by Fannie and Freddie, which is kind of the government agency that backs mortgages. The two entities that guarantee a vast majority of new mortgages. Now, mortgages can be independently held by the institution that they are, but those two government organizations do hold a majority of mortgages. The LLPA are based on loan features based on your credit score, loan to value ratio, occupancy, if you're the owner or a non-owner occupied home, and most recently, the debt to income ratio. Now, what lenders does this apply for? So any loan guaranteed by one of the agencies, regardless of the lender, which are most in the United States, which again, there are some private ones that are privately held. Example loans that would not be affected are FHA and VA, as well as certain jumbo loans, specialty products. Non-conforming loans are not impacted as they are not guaranteed by the government backing agencies. Now, again, very important to remember, guys, it is the government that is backing these loans through Fannie and Freddie. So when does this take effect? Like we said, guys, it is May 1st of 2023. That means that many lenders will begin implementing this in March and April to start and comply with the new changes. So what are the changes in a nutshell? This is kind of the important part, guys. The effect penalty for having a credit score under 680 is smaller than it was. So great. So when you look at that B tier credit, the penalty for having a lower credit score is going to be smaller. It will still cost more to have a lower score. That is, again, one of the very important things to note is that if you have perfect credit, if you have a lower credit score, it will still cost more to have a mortgage with a lower credit score. For instance, if you have a 659 score and you're borrowing 75% of the home's value, you'll pay a fee equal to 1.5% of the loan balance, where you'd pay no fee if you had a 780 credit score. That is kind of something to remember. So if you had a 659, you're actually going to pay a higher fee. Based on if you had a 780 credit score, you would have to pay no fee. But before these changes, you'd have to pay out a whopping 2.75% fee on a hypothetical $300,000 loan, which is average. That's a difference of $3,750 in closing costs. That is right, guys. That is where you can kind of see the changes there in a nutshell. And again, I wanted to go specifically through this. So elsewhere on the spectrum, things got worse. Borrowers with higher credit scores will generally be paying a bit more than they were previously structured. So if, again, you're getting a mortgage, it is going to be more expensive. Now, there is a chart on here that I'm going to show. So you can see the green and yellow cells within this chart. Orange and red are more expensive. All values refer to the percentage of the loan balance charged as an upfront fee. That is right, guys. This is going to be incorporated into closing costs. This doesn't necessarily come out of your pocket up front, as lenders will offer higher interest rates in some cases, and a lot of the fees you can actually just roll into the mortgage. So again, for a lot of people, not going to have an incredibly high effect, I guess, just for the simple fact that you are kind of paying it up front. But that is not the only thing, guys. When you look at this graph, you can see that when you get to the lower credit scores, when you get to kind of the higher, the LTV ratios or the percentages, it changes a lot when, again, based on credit scores. Now, theoretically, the higher your credit score, of course, it's going to be a better rate over the long term, but it is going to be more of a fee up front. So there are two changes that are not easily translated. The most notable is new charge for the debt to income ratios. Now, this again can affect a lot of Americans depending on where you are financially. I know debt to income ratios are huge when it comes to borrowing, and specifically when it comes to things of that nature. The debt to income ratios are going to be big. Now, this will be a controversial in many scenarios, as income calculations can be very subjective, and debt can be calculated and kind of tweaked legally. Now, I want to explain this a little bit because I know a lot of people don't know. If you're in the financial industry, you do. So what you can do to really tweak the debt to income ratios is, let's say, for instance, you have 2 cars, you have some credit card debt, you have a couple other things. You can essentially take that loan amount out as a, let's say, unsecured debt, whatever, regardless of the rate. Of course, it's going to affect the payment a little bit, but you can stretch the payment out longer, affecting the debt to income ratios. So what I mean by that is, theoretically, if you think you take out a $20,000 loan, you take it over 36 months, your payment is going to be X amount, which is going to affect your debt to income ratio, because now your debt in relationship to the debt that you're paying, your monthly liabilities, is going to adjust. Now, if you take that same 20,000 and instead of 36 months, you go to, let's say, 48 months, or you go to 60 months, or you go to 72 months, stretching that out is, of course, going to lower your monthly liability. In turn, that is going to lower the debt to income ratios. So if you know that debt to income ratios could be an issue when it comes to buying a new purchase, you can tweak it in advance by planning. Debt consolidation is really a big one. Nevertheless, every loan guaranteed by an agency has a DTI attached to it. If yours is over 40% and you're borrowing more than 60% of the home's value, you are going to be paying more than if your DTI was lower or you were borrowing less than that 60%. And that is kind of where it comes in with that graph, guys. Now, here are a few examples really to understand. So within this specifically, they have created a new credit score band, which is a 760 and a 780. So that is very, very high A+ credit, guys. Usually A+ is 720 or higher. Within this score, when it comes to mortgages, it is 760 to 780 plus, which again is huge. There's more differentiation in higher balances versus lower balances, several changes to different property units, and there's a big increase in fees for cash out loans. There is going to be, again, a significant increase with the fees when it comes to cash out loans. So where can I actually see this, or where can you see the specific changes? If you have a loan in process, more than likely they will not apply. Again, most lenders will not implement them right away. If you're asking them, they have to make sure. If you could check out Fannie Mae, see exactly what it is. So again, there are going to be a lot of changes coming with this. And again, I'm going to put that up so you can kind of check it out and see where the numbers kind of fall based on debt to income ratios, or the amount that you're borrowing in comparison to your credit score. So again, guys, it seems like that a lot of the better credit scores are paying or are paying more than what you would be paying if you did have a lower credit score. But of course, with a lower credit score, you're going to have issues with approval. You could also see it's kind of less closing costs or less costs up front, but the rate will be higher in the long term. So again, it's going to be a little bit more expensive if you're looking to buy a new home, is really the bottom line. All right, guys, so that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.